Well, today I have a very special guest, and I think we're going to have some interesting times because I always like to bring somebody on from the home office who knows what's going on to give us a little bit. And I want to introduce my good friend from Protective Life and West Coast Life, John
Deramo.
Oh, I just went space. I had a senior moment. John Deramo.
That's okay,
John,
but you're the savant of insurance marketing.
Well,
so
this is all I know. This is all I don't even know your last name. But you know, I noticed now, of course, you're Senior Vice President and Chief Distribution Officer of both companies now.
That's right.
But I'm really interested because we've all heard the merger issues and everything else, and I'm always interested in, well, why was West Coast Life not known as much as Protective, or was Protective moniker in the market, was it more Protective? Although I must say, strictly from an insurance point of view, Protective kind of says it. It's an indemnification word, right? It's an adjective that people would actually get.
It sure
So
is.
talk a little bit about, why did we go down this road, and what are we going to get with this single brand?
Yeah, well, that's a great question. A lot of people are wondering about that. Really, I think it's an evolution of the insurance markets over the past few years as brokerage has evolved into more the dominant form of distribution. I think it's really an outgrowth of what consumers are looking for, and in choice and objectivity, transparency of pricing. They're asking of that of their advisors, and then in turn, advisors look for that in their providers, both in the intermediaries as well as insurance companies. And I think that's really what's driven this consolidation. Historically, we had Protective Life, which operated largely in PPGA markets as well as stock brokerage institutional markets, and West Coast Life was our brokerage distribution. For years, we even ran different product and compensation strategies within those. Completely different
Right.
within those two spaces. But over the last few years, there's really been a convergence in the insurance markets with how advisors are looking for companies. And we came to the realization, and certainly expenses are a consideration as well, that we would be better served, as well as the advisors better served, just kind of consolidating our approach under the Protective moniker, and then as well just focusing solely on brokerage distribution, which for us comes in two flavors, or independent agent distribution as well as institutional distributions through stock brokerage, bank, etc.
Well, I've noticed throughout the years, and this is a little history dating both of us, we've been in this industry like forever.
Yeah.
But I'm looking at
You a lot longer than me.
I have
obviously.
almost 30 years for sure, without question, and I keep those. When you broadcast in 1080p, it's very unforgiving. So,
Yes.
Joe and I think we might have to do a nip and a tuck here in about a week or so.
Indeed.
I'm looking, though, I think economies of scale, when I think of mergers, we're going to eliminate redundancies. We're going to get the trying to hone down on profitability, because you are a publicly traded stock company.
Indeed. Yeah.
But the thing I really like is, during this time period in your history, you guys have always been a major player for agent compensation. That's not going away.
That's right.
I mean, that's what people wanted to know. That was the first thing was, well, okay, what's happening now? And it's always been a very big street contract. It will continue to be that way under the new one. Is that correct?
Yes, that's our intent. Yeah.
Now, I noticed also Protective, in this, will there be any change in issues like retention versus automatics? Or are we still doing it within Protective's thinking and underwriting?
Yeah, it's still within Protective's thinking and underwriting. We've run West Coast Life and Protective Life in a parallel path over the last couple of years. So over the past few years, we've consolidated and standardized not only our product platform, underwriting platform, our service platform, much of our service platform, and as well our compensation structure. So really, this is just an elimination of one of the brands and just focusing solely on the single brand of Protective Life. And the expenses, as we all know, operating efficiencies really drive a lot of what we do in the business. So, yeah, the reduction of operating expenses are very significant for us. And just think about it in the sense that if we have a new product, we go file 50 states for Protective Life, 50 states for West Coast Life. Think about the time, think about the delays, the costs, et cetera, et cetera. It really, these redundancies are millions of dollars.
And they're really, fundamentally, now that everything's converged, there was really no reason to have two brands.
That's right. And for a while, for many years, there were distinct followings of Protective Life and West Coast Life in the market. But again, with the convergence and focus more in the brokerage market, people have not really seen those distinct differences.
Yeah, I think a lot of people kind of, on our channel especially, because West Coast was on our side, we came in through, hey, we can do term over the computer, you can do
That's
your
right.
simplified issue.
Yeah.
I think a lot of people were introduced to West Coast Life. Now we're introducing West Coast Life on a lot of other areas, which we'll be talking in the second segment. But from a product point of view, we always have seen West Coast Life on that side being really competitive and on the edge, very top player always. And do I have the hope and prayer that it's going to continue?
Oh, absolutely. Let's face it, Protective Life, while our core belief is doing the right thing is smart business, we don't have a strong consumer brand. We're not Prudential, we're not MetLife, we don't have the John Hancock, the strong consumer brands. Our brand is more with distribution. So clearly, the way that we forge our relationships with distribution is to have a very strong competitive price point. That's really where everything starts. Attractive compensation, and then the way that we're looking to differentiate ourselves out of the scourge or commoditization as we see in the marketplace is through innovative products and offerings, and that's how we're trying to set ourselves a little different, other than just having a great compensation, a great price point on our product.
Now, with this merger, we know we're already in the merger. We're already dealing with Protective Life.
Yeah.
But now your old PPGA channel now, are they now still staying with you? And then there's everything being consolidated on one platform, one compensation? I mean, it went all down to one issue, right?
Yeah, indeed, it is. And we're transitioning over the course of this year. And what we're doing on our PPGA business is that we are grandfathering the contracts that the PPGA agents currently have. They have to validate those contracts going forward as it should be. But they'll be able to keep the benefits and compensation that they had previously. But if the contract's not validated by the end of the year, then everything goes into a standard brokerage type of setting.
Now, when I'm thinking of the end of the year, this will all be done, right? I mean,
Yes.
it's not September, but really more towards the end of the year.
Yes.
Now, do you see anything on the horizon from a product point of view? Are you guys messing around with some kind of actuarial, construction down in the basement of Protective?
Well, we are working on a lot of things. We've got a number of innovative offerings that we've brought out to this point and will continue to bring out. And really, the point of the operating efficiencies is really to take those efficiencies and plow that into R&D, both on product as well as process, that we can pass those efficiencies out into the field in the form of innovative products. I think we're going to talk about one of the ones that we're
second
doing
segment, definitely.
a little later. And we've brought out a number of things over the course of the past year, and that's we should be more nimble and flexible than the other big battleships in the market, and that's where we're looking to differentiate ourselves.
Any sneak preview before the end of the year on what you might be coming out of the laboratory of the actuarial science officers down there?
Oh, well, I tell you, they hate when I get ahead of things.
Well, just a little insight.
I'll give you a little flavor
Yeah.
of it. We've rolled out something this past year called the Return of Substandard Charges option. That's where we, if anyone is rated above a standard rating, say a Table 2 or Table 4, if you outlive the impairment, which we state what the time is, 15 or 20 years, we will refund all of those charges back into the contract and reduce the client to standard rates going forward. We've had that.
I don't know if anybody does that.
I'm not aware of anyone that
Listen,
does
I have a
that.
pretty good mind for inventory here, and I'm just
Yeah.
trying to think of anybody. So if the client, he had a substandard rating, whatever he was tabled at, or flat
Yeah,
X or whatever,
that's right.
and if he lives past what we thought from an actuarial point of view was going to be his LE or his time,
That's
he
right.
lives past it, he gets all that money back and going forward,
That's
standard
right.
issue.
Contractually guaranteed.
Can you illustrate that?
Absolutely.
I think
it's
that's huge.
incredible.
That's
It is
gonna be
incredible.
huge.
So the breaking news, we're doing that now. It's
And when is
called
that
the
gonna happen?
Roscoe Rider. We're doing that right now.
The
on
Roscoe?
our, Roscoe, Return of Substandard Charges. So we're doing that on our current assumption product.
Current assumption?
Yeah.
Okay.
But the kind of thing that we're working on that we're hoping to bring out toward the end of the year would be on our no lapse guarantee, which would be really really incredible.
So your GUL platform is going to adopt this?
Yeah, that's what we're working on.
And when do you think the expectation? I know you don't want to give a date, but
Yeah, toward the end of the year,
So it's-
fourth quarter. Yeah,
just in time for substandard.
there you go.
Perfect. I love when everything matches my calendar.
Perfect.
Well, on other issues, when I think about distribution and consolidation, I think about how companies are always trying to look at new ones. We've talked about the two that exist now today, our side of the industry, the BGAs and the PPGAs. Do you see anything happening yet in the street? And when I come back, I'll talk to you about this because I want to kind of just ask you that before we get into this new idea.
Okay.
I'm sitting here again with John. I'm so sorry, I keep forgetting your last name.
John Daramo.
Daramo, and I'm having a senior moment all day long. You can watch all our shows on the biz at brokersalliance.com. Check us out on our website at www.brokersalliance.com. And remember, you're listening to the Business Insurance Zone. I'm Steve Savant. We'll be right back after this break. Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new. Back to the Business Insurance Zone, the talk show that focuses on insurance in your practice. I'm Steve Savant, your host, financial color commentator, and mentor in the industry. I want to remind everyone that you can watch all our shows on The Biz, which is on our on-demand section of Brokers Alliance, Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, brokersalliance.com, and to check us out on our social networks on Facebook, LinkedIn, Twitter, and the Insurance Forum, where I personally blog. And remember, I'm not an attorney or a CPA, so if you got any ideas that you pick up from our program, always check with your legal counsel first, and with your broker-dealer, always check in with your compliance officer. John, in our first segment, we were talking about all the things at the merger, and I just want to tie up one little loose end. Mm-hmm. We know our two traditional channels, the BGA channel, which is our channel, and then, of course, Protective's PPGA channel.
Right.
Is there anything else you're looking to expand? Because I know you play in the wirehouses. I know you guys do independent BDs.
Yep.
Anything else expanding because of the merger?
Well, we really see growth in the institutional space, and really where we see it is kind of an outgrowth of what we've been talking about to this point, where customers are looking for choice, objectivity, and transparency in their pricing. And more people than ever are going to their stockbroker, bankers that are involved in the insurance business, and then accessing through brokerage because they offer single source, multi-resource of choice. So I really see that that channel expanding for us. And if you think about it, I think one of the biggest challenges that we've got in the industry is young talent coming into the insurance markets, and it's something that we've been watching over the years is the aging of general insurance agents, but independent producers in stock brokerage and in bank are typically 5 to 10 years younger than their counterpart on the insurance agent side. So that's really where we see the growth of some of the younger markets.
Most of our, I think our population, our agent population is heavily baby boomer. I mean,
Indeed.
we're all turning 65, I guess. There's a bunch that are just turning 65 this year. When I think about stockbrokers, bankers, wirehouses, BDs, I think of variable contracts, which kind of took a sideline after the big hit in 2008. But I have noticed now variables now making a major comeback because we've really gotten better at producing a product, the industry at large. But the bigger issue that I want to talk about is because a lot of people sell VUL not only for their prime reason for indemnification for the client, but they're also selling it for supplemental income. And people are very awake to this idea to get a equity position in the market and have tax advantages that are built around it, which insurance provides. But Protective is doing something that is really unique here. I've been in this business so long that I have clients now taking constructive receipt of their supplemental income. Every year we have to go through the withdrawals to basis, print an in-force ledger. Then that's the good news. The bad news is soon coming, we're going to have to migrate over to loans and then figure out what the loan charges are. If it's current company practice, is it contractually guaranteed? We just don't until we get there. We have to micromanage this every year. It's going to be the same thing.
That's right.
I said this about 7 or 8 years ago, and I can't remember what magazine I wrote an article in. The first real player to come to the table with this idea of doing it all for us is going to be a winner. And you guys, Protective, has stepped up to the plate. Talk about how you're managing, which I think is a huge issue, the distribution phase of supplemental income, especially like on a VUL or a UL current assumption platform.
Yeah, indeed. You brought up a very good point, and it's something that's plagued the variable life distribution over the years. If you think about it, as you mentioned, just the core issue of challenged equity markets. So that's always a very difficult situation, and the fact that people in the day would have taken license to use 12% interest assumptions in the variable life illustrations, and that's something that is tempered itself a lot here over the last few years. But you're right on. Once you sell the contract, it's something that requires regular maintenance throughout the accumulation phase. And then particularly when you get to distribution, there's so many moving parts that are important. Switching the death benefit from option B to option A. As
Maybe
you
even
maximize,
reducing it down to the deferred quarter.
that's right. As you maximize the accumulation throughout the years. Secondly, is the important in the distribution phase of the use of withdrawals, switching to loans, so that you can keep that tax-free income coming in through the years without getting in Dutch with the IRS. So what we've done is a few things. We've got really, it's like VUL on belts and suspenders. We have a program that's called the Defined Objectives Program. And basically how this works is once you sell the variable life product, this provides an annual reproposal every year throughout the lifetime of the contract.
Doesn't have to be ordered, it's auto-plated.
It's auto-plated.
I
So
love
the
that.
customer, when you sell the product, if it's, well, I'm going to put in $500 a month of a contribution, I've illustrated 8%, I'm going to take out $20,000 of income starting at age 65. These were all the assumptions that I had when I first sold that. That all gets put into the computer. So every year you get a review of the performance of the contract to the assumptions that you originally sold to. So in the event that the market goes down, you're not up to the pace at which you originally illustrated the product, then you can input, or you can put in more money into the contract to gas up the values and take advantage of low share prices and dollar cost averaging, et cetera. You might be ahead of the game. You might be well ahead of the game, and your objectives might have changed throughout the year, so you might want to take some money out of your contract early for different unforeseen emergencies and things like that. So those are all things that you can do.
Now, do I have to tell it at the time of issue, or do I have to inform home office, oh, now we're ready to take level distributions, and please make them withdrawals basis possible loans, whatever the format is necessary?
Yeah, you still would have to initiate the loan or the withdrawal
distribution.
process when you're ready to go distribution. And at that point, the Defined Objectives Program will continue to monitor the contract going forward, and this system is built so that it will switch from option B to option A. It will do withdrawals. It will switch to loans. It will keep all of that through the distribution phase in a belts and suspenders mode for you.
I'm sorry because usually I'm not that enamored by the bureaucracy of how people do things, but because this has been a hassle, most of us were selling supplemental income in the early 90s, and all of our clients who are taking distribution, this is all happening now.
That's right.
And so it's been a nightmare and a headache. You're offering we have to ask for in-force ledgers. Then we have to tabulate, okay, what do we have to take out? Then we have to make sure that the carrier says, oh, here's the loan charge.
That's right.
And every year that can change. So what I really like about yours is you've boilerplated an idea. Now, that's on VUL. Is that on any other chassis?
We don't have it on our other chassis, but we are looking at it. And this new program that we're running out, where we're giving some simplified underwriting to the variable life program within certain guidelines and limits, we think this will get a lot more exposure. So we're working on a counterpart product. Again, I don't want to get ahead of the product development process. Folks love when I do that. But we're working
It's
on
no problem. Just remember, it's the World Wide Web, John.
That's
Everybody's
right.
hearing everything you're saying.
This is being recorded, isn't it? We're working on a counterpart product that would be a fixed counterpart to the variable. So you could offer fixed and variable as we go through our initial foray with the variable product here. But you know, Steve, another big thing that happens of these contracts, a big risk in the contract, is let's say you bought it at 45, you fund it to 65, you take income, and now you're out at age 85. So 40 years have gone by. You've taken out a pile of money out of the contract, the market goes against you, and the contract collapses. And here you are, 85, 90 years old. You've taken out a lot more money than you put in, and typically that would generate a taxable event because of the collapse of the contract. So we have another feature. It's built into all of our variable life contracts called Benefit Guard. So if you hold the contract 20 years up to age 65, the contract will not lapse. No matter what happens to the performance of the contract, no matter how much money you take out.
Now, you may be
we
out
keep
of
it-
money, but it's
you're
not
out
gonna
of money.
lapse,
We keep
but
a
it's
de
not gonna-
minimis death benefit in place, and the contract stays
It's
in force.
20 years or age 65?
20 years and,
And
age 65.
And age
Yeah.
65. That is huge because, especially in a marketplace, we have many carriers now doing this new technology of dialing your mortality, and we kind of forgot that if this contract lapses or matures for that matter,
That's right.
all the policy loans become a taxable event. Phantom income is generated.
Indeed.
And not only, by the way, the policy loans, but nobody pays the interest on these contracts. They use the cash values to cannibalize these loans. And so it's not only the taxable event on the money I took constructive receipt on, but now I'm paying taxes on the actual internal loans. If it defaults, it's a double whammy, so to speak.
Yes, it is.
And so if you're in this contract 20 years or longer and or hit age 65, right?
Yep.
You're going to be able to say, even though I might be out of money, my contract will still stay in force, some marginal number just to keep the contract in
Exactly.
force.
Yeah.
Well, I think that's a huge issue. Now, is that already out on the street?
Yeah, that's
And
already out on the
We're
street.
rolling this out.
Yeah.
Now, and our wholesalers talking, protective wholesalers
Yeah,
talking about
they
this?
sure are.
Okay, well, I'd really like to be able to, you have pieces on this. You'll send that to us.
Yes.
If you ask, all you have to do is call me, 1-800-290-7226, extension 147, or just write the biz at brokersalliance.com. We'll send you all the information. There's been some really cool ideas here.
Yeah,
I
great.
love the VUL management. John, how do you think people got into this? Because when you're one of the first carriers that comes out with something like this, somebody has to be in some think tank down at the home office, fantasizing about what agents want.
Yeah.
This is a huge dream come true for guys like me.
Yeah.
So how did that happen? How did you?
Well,
how did you make that
it
happen?
is. It's really kind of indicative of how we do product development at Protective, and we start at the consumer level. We really start with consumers' needs, wants, and desires. And this issue of rising taxes, tax control, the shift of personal responsibility from the government and corporate sources in retirement planning onto the individual is a huge consumer issue.